You know the scene from the movies, right? That chaotic trading floor, people shouting, phones ringing off the hook. But what's actually going on behind all that drama? Well, today, we're going to cut through all that noise and get right to the core theory of trading, from the basic idea to how it really works in practice.
So here's our game plan. First, we're going to nail down the big idea. Then we'll take a look under the hood at what makes the market tick. After that, we'll get into how you can find a trading style that actually fits you, weigh the super important risks and rewards, and finally, we'll cover the single smartest first step anyone can take.
All right, let's dive right in with Section 1, the big idea. To really get a handle on trading, we have to build a solid foundation of what it actually is, and just as important, what it isn't. So let's just ask it straight up. If you strip away all the confusing jargon and the crazy-looking charts, what are we really talking about when we say trading?
Okay, at its heart, it's pretty simple. Trading is just the buying and selling of financial assets. Things like stocks, currencies, commodities. But here's the absolute key. The goal isn't to buy something and hold onto it for decades. It's all about trying to profit from those price wiggles that happen over a much shorter time, maybe even in the same day.
And this right here perfectly shows the massive difference between a trader and an investor. They are not the same thing. Think of the trader as a sprinter, reacting to the market's quick ups and downs. The investor? That's the marathon runner, focused on the long, slow, steady growth of something they actually own. We're talking two totally different mindsets. And that leads us perfectly into our second section. Now that we know what trading is, let's explore the engine of the market, the basic mechanics that actually make it all go. For all its complexity, it all boils down to one of the oldest ideas in economics. The one force that moves prices up or down in any market is the simple push and pull of supply and demand. This quote really just says it all, doesn't it? If a whole bunch of people want to buy something and not many people are selling it, the price is going to get pushed up. On the flip side, if everyone's trying to sell and nobody's buying, the price has to fall. A trader's entire job is to analyze the market and try to figure out which way that balance is about to tip. This shows us that good trading isn't just making a single bet. It's a disciplined cycle. It all starts with education and building a strategy. Then you analyze the market to find an opportunity. You open your position, you manage it, and you close it. But see, it doesn't end there. You have to review what happened to learn from it. And notice how risk management is there at the end. It's not just one step. It underpins the entire process. So how do traders actually do that analysis? Well, there are basically two main schools of thought. Fundamental analysis is kind of like being a financial detective. You're digging into a company's reports, its management, the health of its industry, all to figure out its true underlying value. Technical analysis, though, is more like being a pattern spotter. You're just looking at price charts and data, trying to predict where the price might go based on how it has behaved in the past. All right, that brings us to something a lot more personal in Section 3, finding your trading style. And this is a huge deal because trading is definitely not a one-size-fits-all kind of thing. The perfect approach for one person could be a complete disaster for another. I love these analogies because they make so much sense. Are you a day trader? That's the sprinter, in and out of trades really fast, all within a single day. Then you've got swing trading, which is more of a middle ground. You hold trades for a few days or weeks to try and catch a bigger market swing. And then there's position trading. That's for the marathon runner, someone who's patient, has a big picture view, and might hold a position for months or even years. Okay, we've gone over the mechanics and the different styles. Now it's time for a little dose of reality in Section 4. We're talking about weighing the risks and the rewards, because you really can't have one without the other. So what's the appeal? What draws people in? Well, of course, there's the chance to make a profit. But for many, it's also about the incredible flexibility and independence it can offer. And because markets have high liquidity, it's usually easy to get in or out of a trade. Plus, it's a constant learning process, which is a reward in itself for a lot of people. But we have to be real about the risk. And this number is a pretty stark reminder: 71%. According to data from one major broker, that's the percentage of regular retail accounts that lose money trading complex products like CFDs. It's a really powerful stat that just goes to show you, while profit is possible, losses are actually very common. And a huge part of that risk isn't even in the market. It's in our own heads. As this quote points out, fear can make you sell at the worst possible time, and greed can make you hold on for way too long. Honestly, the real battle is mastering those emotions. That's what really separates the consistently successful traders from everyone else. So, with all those risks fresh in our minds, how should anyone even think about getting started? Well, that brings us to our final section, Your first move is learning. This is all about how to start smart. This right here is probably the most critical point for any beginner. Before you even think about putting real money on the line, your first and only job is to learn and to practice. I mean, you wouldn't try to fly a plane without spending hundreds of hours in a simulator, right? The very same idea applies to the markets. And the fantastic news is that there are tons of ways to practice without risking any of your own cash. You can do what's called paper trading with virtual money. Almost every broker offers a demo account you can mess around with. There are stock market simulators and games. All of these let you test your strategies and just learn the mechanics in a completely safe, stress-free environment. And that brings us to our final big question for today. We've seen that trading is a mix of both careful strategy and some pretty intense psychology. But which one do you think is ultimately more important for success? Is it having a perfectly designed genius-level system, or is it having the mental discipline to actually follow a pretty good one? That's the question every trader eventually has to answer for themselves.